we need to know what a group of company is. So what is a group of companies? What is a group? What is a group of what year of companies? So according to business combinations, IFRS 3, consolidations, IFRS 10, a group of companies constitute what and what? It is a parent. It is a parent plus what year? Plus subsidiaries. A parent plus its subsidiaries. A parent plus its subsidiaries. Those two subsidiaries could be many, but parent can only be one. Subsidiaries, children could be many. Parent can only be one. When you put parent and subsidiaries together, then you'll be able to get what we call a group of companies. And remember, by definition, a parent is that particular company that has got control. Which has got control over who? Control over others, control over other companies known as what here? Subsidiaries. So the parent have got control over subsidiaries, have got control over subsidiaries. And then of course now subsidiaries are the ones that are being what here? These are the ones that are being controlled. These are the ones that are being controlled. The ones that are being controlled by parent companies. Ladies and gentlemen, if I hear, anytime I hear about parent-subsidiary relationship as an auditor, then I need to know a few things. I need to know about this thing of control, right? So control, remember, as we said, control, ladies and gentlemen, is this ability of the parent being able to run the subsidiary. You are running the subsidiary from wherever you are. So if you're the parent here, you are able to run the subsidiaries simply because you control them. So you are able to define, and for example, say, out of 5 directors, let's have 4. So 4 directors are being appointed by who? By the parent. Right? So, ladies and gentlemen, then it will be very good for me from the word go to really try to ascertain this control as an auditor. Does it exist? So I'll want to know, for example, if it is this subsidiary, how many directors does it have? 10, for example. So out of the 10, I would want to get an undertaking from the board of directors. How many out of these 10 were appointed by the parent company? I mean, I would even go to the AGM meeting notes and see which directors were being, in this case here, voted for, which directors were being recommended by who, were being recommended by the parent company, right? So it will be very important, ladies and gentlemen, for me to get to ascertain this control. What is their shareholding? What is the shareholding of the parent company in the subsidiary? Right? Remember, for you to become our subsidiary, we expect, ladies and gentlemen, through the definition of control, for you to become a subsidiary, the shareholding should be more than what? It should be more than 50%. Should be more than 50%. We should be owning more than 50% of this subsidiary. So I would want, ladies and gentlemen, to get the registration documents of this subsidiary. Right? I'll ask from the Register of Companies, it's about 1,000 bob or 600 to get, in this case here, the CR12. When I get the CR12, I'll be able to see who are the owners. First of all, what is the total share capital? Number of shares, maybe there are 1 million, right? How many, in this case here, does the parent claim to be having? If it's 60%, 600,000 shares. If I ascertain that for sure they have 60%, then automatically this will be what here? Will be our subsidiary, will be their subsidiary. So remember, auditing is all about what here? Proper. Search for what here? Evidence. So you have said this. Skepticism tells me I need to still get more evidence. You told me through a management representation that, hey, this company is my subsidiary. It doesn't stop there. I still have to ask, do inquiries to be able to really get sufficient, appropriate audit evidence, which I'll be able to use to do what here? To form an opinion. So today, ladies and gentlemen, of course, before I go to what I want us to discuss today, we also have, if this is your subsidiary, when you are acquiring it, of course, there must be a purchase agreement. When you're acquiring shares, there must be a purchase agreement. So if I'm an auditor in terms of audit procedures, I would want, ladies and gentlemen, first of all, to see whether this purchase, was it approved by the board? So I would ask for the board minutes. I would want to know if the board approved, what amount was approved, in this case here, as the purchase consideration. I would want to know that. If you tell me it is 20 million, then there is no problem. That is you telling me. Remember skepticism. Remember the concept of evidence from outside there being more reliable from evidence that or rather compared to evidence that I'm getting internally. So if you tell me that you spent 20 million, I would want in this case to get a bank statement to really confirm that the 20 million in this case here was debited from my account, from this account of the company I'm in, right? What was the accounting in this case here treatment of this? Right? At the date of acquisition, ladies and gentlemen, I also must get to confirm what was the fair value, what was the market value of the shares on that date of this subsidiary. If the subsidiary is trading at the stock exchange, I would want to know what was the fair value of the shares at that date. Why am I interested in getting the fair value? I'm interested in getting the fair value because of the non-controlling interest. Remember, the shares, the investment of NCI must always be pegged on the fair value of the shares on that date. So I would want to know, I must ask these questions. Now, the other thing, ladies and gentlemen, of course, in terms of the accounting entries, it's possible that this subsidiary was acquired at a higher price in comparison to what are the net assets. So it's possible that, ladies and gentlemen, this particular subsidiary, we acquired it at some goodwill. So if goodwill exists, two things. I would want to know how it was computed. I would want to know, ladies and gentlemen, whether from the time it was put into the books, from the acquisition date to today, is there any impairment loss? Is there any impairment loss? Great. So that allow me to introduce today's concept. So today's concept is a great concept that we should be able to really understand. Okay. So please let me know whether you are able to see my screen. Are you able to see my screen? Are you able to see my screen? Are you able to see my screen? Yes, and I promised you these notes. I've been out of WhatsApp for some time. Great. I should be able to send them today after this class. Now, I'm looking at a situation where, today I would want us to look at a situation where we've done our group audit. We are the principal auditor. The principal auditor is also known as what? The group auditor. The one who has a responsibility over the group audit. The one who is auditing the parent company. The one who is auditing this parent company is known as the principal auditor. At the end of the day, is the one who has got a responsibility over the overall group opinion, right? The ones in this case here who audit the subsidiaries, we call them the component auditors. We call them the component auditors. Ladies and gentlemen, component auditors have a responsibility over subsidiaries. But remember, for me to be able to form a group audit, then I would want to be given information by them. I would want to see their opinion. I would want to measure the quality of their work. Because fine, they are doing the audit over the subsidiaries, but at the end of the day, I would want, in this case, here to consolidate all those opinions, of course, depending on the materiality. Now, the first thing that will arise, you will come and, for example, realize that one of the subsidiary is really struggling. It has got what here? Going concern issues. So if it has got going concern issues, what will be the implications? Right? Right? Do I go ahead and make disclosures in the opinion? in the audit report. If I make disclosures in the audit report, of course, there will be repercussions in the industry. Remember, an auditor, especially if you raise anything to do with going concern, then automatically that company will go under. Look at Chase Bank, right? Once in this case, an auditor comes and does a disclaimer of opinion, or he goes ahead and he gives a going concern issue, raises it, going concern issue regarding a company, then that is the last nail on the coffin of this company. This company will go 6 feet under. And really, as auditors, we're not here to bury companies. No, we would want in this case to raise these things in a way that management should be able to rectify. And then, of course, they move ahead so that at the end of the day, the shareholders don't suffer injuries. So then if, for example, some going concern issue has been raised over a subsidiary, of course, as a group auditor, my responsibility is to raise these with the parent company. The parent company knows the repercussions of us taking them to the media, of us taking them outside there publicly, even if it's just a component, saying that the component has got going concern, that will be misunderstood. And of course, people will think that the entire group has an issue. So before I do that, it's very important for them to appreciate the repercussions, right? So I'll go to them, tell them I've done my proper research, and I've realized that this subsidiary of yours has got big problems. So then the only way that you guys need to get out of this, please give me like a comfort letter, a letter of support, that you will be able to do what you to support this institution so it doesn't go where? Under. Letter of support, very important. So this is what I would want to teach you this morning, ladies and gentlemen, called comfort or support letters. So letters of support to comfort regarding going concern. When the parent is undertaking, or even a fellow subsidiary, is able and willing to provide support to a struggling subsidiary. Great. So we told you that group accounts are prepared on a going concern basis when a group as a single entity is considered to be a going concern. So often the parent might have to guarantee this for other subsidiaries. Many banks routinely require a letter of reassurance from a parent company stating that the parent would financially or otherwise support a subsidiary with a cash flow or other operational problems. So as audit evidence, what are my audit procedures, ladies and gentlemen? I would want to hear, ladies and gentlemen, this from you. What kind of audit evidence will you be able to gather? Will you be able to gather for you to really be comfortable also as an auditor that this subsidiary will be supported? So regarding this support letter, comfort letter that, for example, you have received from the parent company that, hey, we know that this subsidiary is really struggling, but hey, we choose to stand with it. We choose to stand with it. So before you take this straight away to your working papers as a very good support letter, what other things are you going to look at? Audit procedures. Audit procedures. Remember, audit procedures are the same. As a way of collecting audit evidence, they're the same, right? So a commitment over how much they will support. So according to Lily, she would want in this case here to get like a management representation, right? What kind of support? How much will you be giving? Okay, I like that, right? Yes, the concept of how long, again, I would need in this case here a representation letter or one letter which will be able to provide those commitments. How long? Don't tell us that we'll be supporting. You know, if it's a one-off support, these guys in this case here may get that support, say a 1 month support, and then after that they collapse. And they have to require to look at 12 months ahead. Remember, when we issue an audit opinion, we are giving people kind of an assurance that 12 months from today, this company will be a going concern, Thank you very much. You guys are giving me very good points. Any question on how much the support is? Yes, that already you have said. Thank you very much. Remember, if it's audit evidence, if it's audit procedures, confirm the cash flow of the parent company to confirm whether it has got capacity. Great, great. Because this company which is giving guarantee, maybe even itself it's struggling. So this lady is giving me a very good point there that I would want to confirm their cash flows. Actually, as an auditor, I would ask for what here projected, right? Projections of both the subsidiaries and what here the parent company and the parent company. Thank you very much. Let's read them. Although anything that you say under audit procedures, under audit evidence, ladies and gentlemen, so long as you expressly put it down, you can never go wrong. You can never go wrong. The only thing you need here is basically confidence. The only thing you need here is basically confidence. So you're told here, as audit evidence, formal confirmation is a comfort letter confirming the parent's intention to keep the subsidiary in operation what year existence. So I would want this formal confirmation. I would want this in form of what year? A representation letter. This letter of support should normally be approved by a board minute of the company. So the concept here is that I would ask for board minutes, in this case here, to be comfortable, even as an auditor for sure, that this thing has not come from a single individual director. Remember how companies are run. Companies are run through what we call force versus habitol. Force versus habitol is the concept of what here majority in the board will rule, the 50% plus one. So of course, one of the directors will take this as a minute, not a minute, but as an agenda, that, hey, this subsidiary is struggling. What do we do with it? So I would want to see really whether this particular agenda was discussed and voted for. And if it has been voted for, so it must be resolved. It must be under a resolution. So I would want to get board minutes just to be comfortable that for sure this comfort letter is binding, legally binding, because if it has only been passed by one director and maybe there are 10, trust me, that thing is not binding. So I would want to get board minutes. Everything starts from the top, the board minutes, very important, board minutes. Great. Number 3, the ability of the parent to support the company should also be confirmed. For example, by examining the group's cash flow forecast. I love what this lady told me. I think it's Helen. She told me, hey, as a parent, there is no way you'll come, for example, even to RCM college. You leave, in this case here, your son with me here, right? I would want to know really your capacity to come and pay these fees later. It will be very important. Capacity. Right now, most headmasters are very serious about that because most of the parents will take their kids to some of these schools and they don't honor the obligation. So nowadays we want a commitment, a serious commitment, and we will have to see really this parent, even from history, does he or she have the capacity to pay, right? Tell me, where do you expect to get this money? Is it from, for example, your end month salary? Of course, as a headmaster, I may not be able to try to get everything from you like payslip, but if it's an auditor, I would want to get all assurances, cash flows. Give me even bank confirmations that really you've got this capacity. It's not a joke. This is not a joking matter, right? Now, ladies and gentlemen, from there, we are told note number 4, the period of support may be limited. We will have to specify this, e.g. 1 year. Sufficient other evidence concerning the appropriateness of the going concern assumption must therefore be obtained where a later repayment of material debt is foreseen. The fact of support and the period to which it is restricted should be noted in the subsidiaries' financial year statements. Listen and listen to me. These subsidiaries' financial statements, we expect those directors to disclose. So what I'm saying as an auditor, as an evidential fact here, I'll have to go to the financial statements of the auditor, of the subsidiary, the disclosure side, where they disclose, not the accounts, right? We expect the directors in this case here to own up and say, hey, fine, you're struggling, but here we happen to be having a comfort letter from our parent. It's an undertaking that they have given us that they're going to support us until we go back on our feet, like that. Now, ladies and gentlemen, of course, you realize even as I speak these things through, I'm really moving quite fast because I don't expect you to cram. All the students in this case who end up cramming these things, they don't really pick them up very fast. It's about audit procedures. It's about RAEOU, right? In this particular case, because it's a comfort letter, basically most of the things is about inquiries. Inquiries from management, inquiries, for example, even from the banks, right? Inquiring in this case here from the directors of the subsidiaries, for example, regarding adequate disclosures, etc., like that. And of course, even checking, reviewing the document, reviewing this comfort letter. I have to review it very well. Is it a genuine one? How do I ensure it's a genuine one? Does it have support from the board minutes, right? How do I ensure it's a genuine one? Do I have, in this case here, management representation? You've given me the support letter, but just do another taking from the chairman, etc., signing that really this is our commitment that we undertake to support this company for this period, And of course, the period has to be limited to at least 1 year. Remember the concept of going concern. We're giving assurance to the public over what year? 12 months. Ahead of us, the company will be there. Let this not be the case of Uchumi versus PwC. PwC, they gave a good report about Uchumi. Good report. And these guys really, they had known about, for example, the crafty, right, sale and leaseback, where Uchumi in this case here was able to sell, like the head office here along Arakan, and they sold this head office to the directors of the company. So we have sale and leaseback. So they sold this head office and the other branches to the directors, and the directors leased these properties to Uchumi Supermarket at a very crazy rate. Very crazy lease rentals, right? Very high lease rentals, sale and leaseback. These people were not even declaring what we call related party transactions. Directors are serious relatives of a company. When a director buys anything, even if you buy a cockroach from a company, I'm using a bad example, but it doesn't matter the materiality. In terms of related party transactions, ladies and gentlemen, as directors, when you buy anything, you need to disclose in the notes to the accounts. Why? Because chances are, because of your relationship with the company, you are going to buy that thing at almost zero amount. You're stealing. So in terms of related party transaction, we expect you to come and do what here, declare that I bought this thing at this price. And then the auditors must go and check the market price of that thing and they see whether you took undue advantage, right? So in this case here, PwC, knowing that very well, they gave a clean bill of health. In this case here too, the shareholders of Uchumi, that this company is good. 3 months down the line, the company Uchumi went under, they could not pay their suppliers, right? They could not pay their suppliers, they could not pay their bills when they fell due, right? So it went under. And of course, PwC was taken to court, quite interesting, but of course, given that most of our judges are not very good in terms of accounting and auditing matters, they were able to get away with it, right? If it was in America, PwC, in this case, I'm not to believe they would have really heavily been penalized. But here they went and they quoted this concept of confidentiality, that they owed their client, who is Uchumi Supermarket, confidentiality principle, not to tell. So they got away with it. But otherwise, ladies and gentlemen, it will be very important for us to appreciate these small things. Now listen and listen to me very well. Here we are. Audit of goodwill. The same thing, basic procedures. If I asked you, how do you audit goodwill? I'm so sure you guys will be able to give me like 3 great points. Could you kindly give me the audit procedures? Audit procedures of a goodwill. I'm so sure you guys will give me 3 points very fast. Audit procedures of a goodwill. Is there somebody who can give me these audit procedures of a goodwill? Goodwill. Audit procedures of a goodwill. Thank you very much. Recalculate it under RAEOU. RAEOU. Recalculate it yourself. Recalculate it yourself. So in this case here, recalculate, it's an audit procedure. It's a substantive procedure. Recalculate it. You'll be given a figure, you'll say, hey, no, let me recalculate it. Thank you very much. Any other point? Those points are not coming as fast as I would have really wished. Inquire how it was computed. That is very important. So inquire this, for example, from the finance director, from the audit committee, from whoever, from management. Inquire how goodwill was arrived at. So in short, what this lady is telling us is that ask for a letter of what representation. And in that letter, of course, ladies and gentlemen, you would really want to be told how much the goodwill was, right? Right? Any other point? I can see like 10 of them, imagine. I'm able to see like 10 of them. 10 of them at once. 10 of them at once. Yeah, like confirm the purchase consideration of the. There is no way you can compute goodwill without confirming this purchase consideration. Because how do we normally compute goodwill, my students? How do we normally compute goodwill, my students? How do we normally compute goodwill, my students? To compute goodwill, we will take, in this case here, purchase consideration of the parent. We have purchase consideration of the NCI at fair value, and then we less what here? We less net assets. So it will be very important in this case here to know how much consideration was paid, right? But if I'm the one doing this, once the management have been able to confirm in writing to me how much goodwill is in this subsidiary, how much goodwill was there at the date of acquisition, the next thing that I'll do is to check for disclosures in the financial statements. Because remember, all these figures that you have in the financial statements must have some disclosures down there. So I'd want to see how this has been disclosed in the financial statements. So disclosure. So check the financial statements for disclosures. Check, in this case here, board minutes. Nobody did I see mentioning anything to do with the board minutes. I mean, how do you acquire this? Which method, for example, do you use? So board minutes must be there. Board minutes must be there. And when you talk of purchase consideration, there is a concept of you reviewing even to see whether whatever purchase consideration they are putting here is in the bank statement. Is in the bank statement. Thank you so much, ladies and gentlemen. At least this one you guys tried. At least this one you guys tried. Great. So obtain, yes, the purchase agreement and confirm the date of the acquisition. A simple thing, but very important. Inspect the purchase agreement to confirm the consideration paid and the details of any contingent considerations, that is considerations in the future, including its amount, date potentially payable, and the factors on which payment depends. Confirm the percentage owned through a review of shareholder register and by agreement to legal documentations. Agree any cash paid to cash book and bank statements. Review board minutes for discussion regarding the purchase. Obtain due diligence report prepared by external provider and confirm the estimated fair value of net assets at acquisition. And then, ladies and gentlemen, you'll have to recalculate what here? Goodwill. You'll have to recalculate goodwill. I'm so sure, ladies and gentlemen, that you have been able to pick a few things, a few points here and there that you can really be able to put down. This time around, where they'll ask you about audit of a group of companies. Audit of a group of companies. So basically, it is this RAEOU. Like under R, I'll be able to say so many points, even more than what is given there. Under R, of course, we expect what here? These are analytical procedures. Analytical procedures. Analytical procedures, I'm allowed to compute percentage changes. Like I would want to know this goodwill from last year to this year. What is happening? I can see it was 10,000. This year it's 9,000. What is this percentage change? Why a reduction? Is there any impairment in goodwill? Is there any subsidiary that was disposed in the year which made goodwill to do what, to go down? So I would really want to do so many computations here. I would want to analyze the situations here, right? Right? And the inspection is where we are now inspecting documents. We're inspecting, in this case here, the purchase agreements, right? Would want to inspect the register of shareholders, because when we are computing goodwill, we would want to know the percentage of shareholding, right? Inspect, in this case here, of course, this purchase consideration agreement vis-a-vis what here, vis-a-vis the bank statement. The link is throwing them out. It must be their internet. It must be their internet. It can't be the link. It must be the internet. Otherwise, all of you will be thrown out. Great. So, ladies and gentlemen, from there, if you allow us, we shall be able to move straight away to this concept here, very important concept. What happens if, for example, the subsidiary report is qualified? So what if the subsidiary report is qualified? What are you going to do to the group? Listen and listen to me very well. You, the group auditor, you've done your work. And then one of the component, you've done your work, and from the group perspectives, especially the parent perspective, the opinion is good. The opinion is good, but one of the subsidiary opinion is bad. One of the subsidiaries' opinion is bad, right? Right? One of the subsidiaries' opinion is qualified. So then what do you think in this case here shall you do when you're trying to aggregate the opinions? The parent opinions and the subsidiaries' opinions. What do you think in this case here shall be done? Will you go ahead and issue a bad group opinion because one of the subsidiary has been qualified? Can somebody talk to me this morning? What kind of a report of the group are you going to do, to give out? What kind of this audit opinion for the group are you going to give if one of the subsidiaries iko na dosari, one of the subsidiaries iko na shida, one of the subsidiaries iko na shida, utapenda aina gani? It depends on the materiality. The materiality. It depends on the materiality. If this subsidiary is so immaterial, if it is so small, what some tribe here call Ochugunu, very small, Ochugunu, very small. If it is small in relation to the group, then automatically its results, as and gentlemen, will not do what here, will not really bother us. Will not bother us. But if, ladies and gentlemen, this subsidiary is material, materially, it surpasses the threshold, then automatically you will have to qualify the group opinion. Listen and listen to me very well. Listen and listen to me very well. We are told here, so what if the subsidiary report is qualified? Is the group's report going to be qualified too? It basically depends if the group auditor thinks it's material or not. If so, then the group accounts are qualified too. If not, no effect. And in practice, ladies and gentlemen, normally for materiality of the subsidiary, this is quite subjective. If on the auditing firm that is doing this, but it's very, very subjective, ladies and gentlemen. If we have, ladies and gentlemen, subsidiary A, right, has sales of say 10 million. These sales, and then we have in this case here the group sales. So the group sales, we are talking of parent plus all subsidiaries, maybe plus A, maybe plus B, is say 50 million. The group sales. Now, as a percentage, look at the A sales to the group. So it will be 10 over 30 times 100, which will be what here? 33%. What do you think of A to the group? What do you think of A to the group? What do you think of A to the group? What do you think of A to the group? The 3% is so high. The 3% is so high. It's so high. So remember here we are looking at the groups. We're looking at groups. We're looking at the parent, subsidiaries like that. Ladies and gentlemen, outside there in practice normally, although these percentages keep on varying, but normally any component, any subsidiary whose sales is more than 10% of the group, whose sales is more than 10% of the group sales, then automatically that is a very big thing. It's a very big thing, a very big thing. You get others working with 5%, etc., but 10% for sales, for leave alone the other materiality, right? This is materiality for the group like that, to know whether this subsidiary is material or not. Anything more than any company that gives you sales, which is more than 10% of what the group is giving, of the group sales, then that is a significant component. So if you say this, if it's a 3, and we say that the group here, or rather the report is bad, it doesn't matter what this has. The report has to be what here? The report has to be bad. 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 Now from there, we go to the last area, which is working with component auditors. So component auditors, remember the most important thing is for me to just ensure that these subsidiary auditors are qualified to do the work. They have been able to gather good evidence, sufficient appropriate audit evidence. They used a strategy, which is good, which is consistent with our strategy. And of course, most importantly, that the component auditor is independent of the directors of the company. Now, when we talk of component auditors, ladies and gentlemen, there is really nothing here to belabor. We are told here, the principal auditor, who is the group auditor, should evaluate the component auditor if going to rely on his work. And here we are assuming that this auditor is a lady. She will look at the principal. She will look at, number 1, their competence, qualifications, and experience. Number 2, the procedures carried out to obtain sufficient appropriate evidence that the work of the other auditor is adequate. Number 3, the findings of the other auditors. Number 4, the strategy of the other auditor. So the principal auditor should also perform risk assessments on components, evaluate business risk of components, evaluate susceptibility of other auditors to errors. Very important, you can forget about everything, but the principal auditor must always attend closing meetings of component audit. You must always attend the closing meetings of the component audit. So when these auditors are giving their final findings to the management, closure meetings, the principal auditor, regardless of how busy you are, you must get yourself time or send somebody there to go and sit down there to see how these component auditors, for example, are even advising the management. You'll be able to see the chemistry there, right? So it will be very important for you to attend closure meetings of audit of your component companies. Great. Now, ladies and gentlemen, we are told here, review of component files. It's very important that you get to see their working papers, right? Evaluate whether further substantive testing should be performed at component level. Ladies and gentlemen, remember, as a principal auditor, if you come and realize when you are reviewing the working papers of the component auditor, you realize that there are gaps. This is your group. At the end of the day, you're the one who has the responsibility over the group opinion. So then what that would mean is that if there are any gaps, you must come and close them. You must come and consider whether there are any substantive tests that you can do, right, to close the gaps Very, very important that you have to consider, that you must consider. Great. Now, ladies and gentlemen, I would want us to look at one question for us to be very sure of what we are talking about. And I don't normally see you guys discussing CPA papers. I'm yet to see you guys raising even one question we discuss. But a group, you have to do that. So these are an ACCA question. You examine a copy is an ACCA question sometimes. So you're told here, look at the question here. Comment on the matters to be considered and explain the audit evidence you should expect to find during your review of audit working papers in respect of each of the issues described above. I read very fast. You are a manager in the audit department of Williams and Company. And you are a manager in the audit department of Williams and the Company, and you are reviewing the audit working papers in relation to Francis Group, the group, whose financial year ended on 31st July 2014. Your firm audits all components of the group, which consists of a parent company and 3 subsidiaries, Mark Company, Robert Company, and Teapot Company. Very good names. The group manufactures engines, which are then supplied to the car industry. The draft consolidated financial statements recognize profit for the year to 31st, 2014 of 23 million, 2013, 33 million, and total assets of 450 million. When they're giving me these figures, they would want me to compute the materialities. Great. And of course, when they're giving me these figures, ladies and gentlemen, they would also expect me to do those analyses, analytical procedures. Like now you can see, you can imagine, July 2014 it was 23. 2013 it was 33, right? Decreasing actually. And total assets, in this case here, 450, right? And 2013, total assets here were 455. So I can see my assets are going down. 2013, they were 455. 2014, in this case here, they were what here, 450. And the sales was also going down. I would want this quite interesting. Information in respect of the 3 issues has been highlighted for your attention during the file review. A, an 80% equity shareholding in Teapot was acquired on 1st August 2013. Goodwill on acquisition of 27 million was calculated at that date and remains recognized as an intangible asset at the value at the year end. The goodwill calculation performed by the group's management is shown below. So we have purchase consideration 75%. We have fair value of the 20% NCI. Remember, the parent year has got 80%. Fair value of 20% NCI, 13. They got 88,000. Less fair value of Teapot's companies, identifiable net assets. That's very good, correct. Goodwill is 27,000. So I don't know whether they have considered the impairment. In determining the fair value of identifiable net assets at acquisition, an upwards fair value adjustment of 300,000 was made to the book value of a property recognized in Teapot Company's financial statements at a carrying value of 600,000. So in short, they did a revaluation. It's acceptable, but let's see what they're talking about this revaluation. A loan of 60 million was taken out on 1st August 2013 to help finance the acquisition. The loan carries an annual interest rate of 6% with interest payments made annually in arrears. The loan will be repaid in 20 years at a premium of 5 million. So required, comment on the matters to be considered and explain the audit evidence you should expect to find during your review of the audit working papers in respect of each of the issues described above. So especially this kind of a question, when students see figures being thrown around, most of them will be thrown out of this question totally because of the figures. But really, there is nothing, trust you me, in terms of audit evidence. Like now, ladies and gentlemen, I've seen in this case here that there is a loan which was acquired here, right? There's a loan acquired here. as an auditor, I would want really to be quite convinced that this loan is genuine. The loan is genuine, right? So they obtain the loan agreement and see the terms, right? Right? Even that premium, because I can see there is an interest rate given there, I would want to see, ladies and gentlemen, whether it was calculated correctly. So I would want to recalculate, right? I can see they have given me figures. I can see they have given me figures of goodwill. I would want to recalculate. Could you kindly try answering that question and then we see? I switch. I don't understand the question really here. I don't understand the question here. Somebody has been thrown out. Are you guys not able to see? Are you able to see the question? Are you able to see the screen? This is the most important thing. Are you able to see the screen? 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 Yes. Okay, if you're able to see the screen, that is it really. That is it really. So, and the question they've asked us here is we comment on the matters to be considered and explain the audit evidence you should expect to find during the review of the audit working papers in respect of each of the issues described. So high level, what will I be able to say, ladies and gentlemen, here? High level. I've seen a few things being thrown there to me. What would I want really to say here? High level. High level. Okay, so then let me check here. Yes, they calculate goodwill, they calculate, I love that. Now, ladies and gentlemen, check the board minutes, yes. Now, listen and listen to me very well. Look at what they have done here. Look at what they have done here. Measurement of goodwill on acquisition. The goodwill arising on acquisition of Teapot Company is material to the group financial statements, representing 6% of the total assets. Could you kindly try recalculating that 27,000? This 27,000 divided by 27,000 divided by the group assets. The group assets of 2014 group assets were what here? 450 million, right? So what is 27 divided by 450? 27 divided by 450 times 100. What are we getting there? Yeah, 6%, isn't it? So it's material. So if it's material, then as an auditor, remember I told you about this materiality. of the individual components. Materiality of the individual components. Individual components material. Don't confuse this with materiality of the subsidiaries. Materiality of individual components, I gave you a rule of what here? 1%. Anything that is individual, 1%, more than 1%, that thing is material. That thing is my 6% is so high, it's material. So then as an auditor, I would really want to know whether everything is okay with this goodwill. It's so material. It is so material. It is so material. Great. So we are told here, ladies and gentlemen, we are told here, the goodwill then should be recognized as an intangible asset and measured according to IAS 38, intangible assets, that's okay. The purchase consideration should reflect the fair value of total consideration paid and payable. And there is a risk the amount shown in the calculation is not complete. For example, if there is any deferred or contingent consideration has not been included. The non-controlling interest has been measured at fair value. This is permitted by IFRS 3. And the decision to measure at fair value can be made on an investment by investment basis. The important issue is the basis for measurement of fair value. Now, you remember they told us NCI has been measured at fair value, which is okay, that's permitted. If Teapot Company is a listed company, then the market value of its shares at the date of acquisition can be used. And this is a reliable measurement. If Teapot Company is not listed, then the management should have used estimation techniques according to the fair value hierarchy of inputs contained in IFRS 13 fair value measurement. You can't remember this in an examination. The most important thing as an auditor that I would want to do is to assume, ladies and gentlemen, that the market value of the shares of this subsidiary is known. The market value of the shares of this subsidiary at the date of acquisition is known. I should be able to inquire, right, and ask, in this case here, what was the market value of the shares at this date? Of course, this now becomes the fair value of the NCI to be used to value the NCI. And of course, after being given the share price at that date, I'm also right. The internet is there. Nairobi Stock Exchange is not very far away. I'll need to go and even get like a register showing, in this case here, share prices of various what-year dates on average. And we've got investment brokers, etc. Right? So we are told here that this would introduce subjectivity to the measurement of non-controlling interest and goodwill, and the method of determining fair value must be clearly understood by the auditor. The net assets acquired should be all identifiable assets and liabilities at the date of acquisition. For such a significant acquisition, some form of due diligence investigation should have been performed. And one of the objectives of this would be to determine the existence of assets and liabilities, even those not recognized in Teapot Companies' individual financial statements. There is a risk that not all acquired assets and liabilities have been identified, or that they have not been appropriately measured at fair value, which would lead to over or understatement of goodwill and incomplete recording of assets and liabilities in the consolidated financial statements. The fair value adjustment, that revaluation of 300,000 made in relation to Teapot Company's property, is not material to the group accounts, representing less than 1% of the total assets. Could you kindly take this 300,000 in terms of millions? This is too small, 0.3. 0.3 over, was it 450? Over 450, itakuwa kidogo sana. It's less than what here? 1%. So if it's less than 1%, then I don't have to trouble myself. I don't have to trouble myself. If it was more than 1%, if it was material, and it's, for example, a property that is like land buildings, if it's very material and I don't have expertise over valuing it, then I would need, in this case, an independent an independent valuer. But this 300,000 for sure, it's immaterial. Even if it's misstated, really, it will not have an impact in the financials. I don't know to bother with it so much. Let's continue. And I'm finishing in the next 5 minutes. Please just give me 5 minutes. So we are told here, however, the auditor should confirm that additional depreciation is being charged at group level. The auditor should also consider if any further adjustments need to be made to teapot companies' net assets to ensure that group accounting policies have been applied. Now look at the impairment. IAS 38 requires that goodwill is tested annually for impairment, regardless of whether indicators of potential impairment exist. The goodwill in relation to teapot companies is recognized at the same amount at the year end as it was at acquisition, indicating that no impairment has been recognized. It could be that the management has performed an impairment review and has concluded that there is no impairment, or that no impairment review has been performed at all. However, group profit has declined by 33% over the year, which in itself is an indicator of potential impairment of the group assets. So it's unlikely that no impairment exists unless the fall in revenue relates to parts of the group activities which are related to the teapot company. There is a risk that the group assets are overstated and the profits overstated if any necessary impairment has not been recognized. Now the loan. The loan is material, representing 13.3% of the group's total assets. The loan taken out to finance the acquisition should be accounted for under IFRS 9 financial instruments. It should be initially measured at fair value and classified according to whether it's subsequently measured at amortized cost or at fair value. This one is very complicated. As the loan is not held for trading, leave alone that. Now listen to me very well. Evidence. This is where all your mark will be found. Evidence. Agreement of the purchase consideration to the legal documentation pertaining to the acquisition, and a review of the documents to ensure that the figures included in goodwill calculation are complete. Agreement of the 75 million to the bank statement. Remember, this was the purchase consideration. And the cash book of the acquiring company, right? Review of board minutes for discussions relating to the acquisition and for the relevant minute of board approval. A review of the purchase consideration and a register of significant shareholders of teapot company to confirm the 20% non-controlling interest. If teapot company shares are not listed, a discussion with management as to how the fair value of NCI has been determined and evaluation of the appropriateness of the method used. If teapot company shares are listed, confirmation that the fair value of the NCI interest has been calculated based on externally available share price at the date of acquisition. A copy of any due diligence report relevant to the acquisition reviewed for confirmation of acquired assets and liabilities and the fair value. An evaluation of the methods used to determine the fair value of acquired assets, including the property and liabilities. Review of depreciation calculations and recalculations to confirm that additional depreciation is being charged on the fair value uplift. A review of the calculation of net assets acquired to confirm that the group accounting policies have been applied. Discussion with management regarding the potential impairment of group assets and confirmation as to whether an impairment review has been performed. A copy of any impairment review performed by management with scrutiny of the assumptions used and the performance of calculations. A performance of management calculation of the finance charge in relation to the loan to ensure that the loan premium has been correctly accrued. Agreement of the loan receipt and interest payment to bank and cash book. Review of board minutes for approval of the loan to be taken out. A copy of the loan agreement reviewed to confirm terms, including the maturity date, premium to be paid on maturity and annual interest. A copy of the note to the financial statements, which discusses the loan to ensure all requirements of IFRS 13 and 7 have been made. So the concept here is disclosures must be what here? Must be adequate. Ladies and gentlemen, as we disappear, amongst all those audit procedures of getting appropriate audit evidence, which ones in this case here will you be able to, even as you go to your workplace today, to have them, of course, in this case here, stored in your memory forever? Those audit procedures against goodwill, against those loan, against the loan which was acquired. Please, very fast, just one line as we disappear. One liner. Which ones will I remember? Which ones can I not forget? Because all of them are just easy and they're the same, right? Let me see whether there's anybody who can give me 5 audit procedures on goodwill, on this loan acquired. Then there was a revaluation of 300,000. What will I do? What will I do? On the assessment for materiality. I'm waiting to hear from you because I know you're typing, so I know the answers will come. Very fast. Right? Copy of loan agreement. I love that. Copy of loan agreement, confirming the terms of the loan. Thank you so much. Review of board minutes for approvals of loan. Thank you so much. Right? Right? Those are too nice, but too few, you know. Too few, but I'm so sure most of us are typing as we disappear. I'm so sure most of us are typing approval of board minutes, a report on due diligence. I love that. Recalculating the goodwill, recalculating the finance cost. I have to do a lot of recalculations. If they give me impairment, I have to recalculate the impairment. I love that. Great. As we disappear, I'm waiting for 2 more points as we disappear. Because I don't want to meet anybody amongst ourselves here really sitting down to cram these points. No cramming for us. No cramming for us. It's about understanding these things because they're going to feature all over a new exam. Obtain purchase agreement. Thank you very much. Obtain purchase agreement, and of course, go through it, isn't it? Thank you so much. Review the depreciation policy, for example, and if possible, recalculate the depreciation. Thank you so much. Confirm the said amount in the bank statements, yes. If you said you paid 75 million, yes, let's go to the bank statements and see the figure, because in some cases, people cheat. 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 Thank you so much, ladies and gentlemen. It has been a pleasure hosting you in the morning. Bye-bye. Bye-bye. See you tomorrow, same time. See you tomorrow, same time. Just check disclosures, yes. Yes.